Thank you very much, Sean. Welcome, everyone. Welcome to our Wednesday's class. So pleased to have you. Today, we're gonna go back another session on technical analysis, discussing cup with handle pattern. It's a pattern which is really a classic pattern. And I want to share this with you because if you notice, last few months, I've been sharing a lot of like some charts from Investor Business Daily. And this is a product or an idea that, or the pattern that Bill O'Neill, the founder of Investor Business Daily, developed. So I want to share that because you might see it in some of our charts. I mentioned that when we talk about like stock of the week. So what is the cup with the handle? It's a continuation pattern that makes a consolidation period followed by a breakout. And majority of time, this is a bullish continuation because, as I mentioned, developed by William O'Neill. And if you haven't read How to Make Money in Stocks, especially emphasizing on growth stocks, I will definitely encourage you. I think I have all his books. I have his calendars and all things. And I really enjoy his philosophy. I've been a reader of his paper, started in 1984. I started reading it in 1985. So it's been about 37 years. He was really a pioneer. He used a lot of data gathering and his charts were fantastic. I used to get his chart books because at that time, we really didn't have the internet in a way, and they will send it over the weekend. And it was really great to go through all those charts. And he is, I've met him quite a few times, and he was very much US domestic growth oriented stock investor. And basically he's really evolved, since he did not believe, let's say, in digital, and now, his paper is digital, and he's also very much international, global, he follows a lot of global markets, but his screen is more of a growth oriented. And based on that, that's why he uses momentum. He uses PE expansion and, relative strength, but also he pays attention to the fundamentals. And obviously the growth comes from fundamentals, from the sales, looks at all the profit margins. But at the end of the day, he is more of a optimistic person, believes in the future of United States and as well as globally. So majority of, again, his ideas are more on a bullish side. So this was developed as a bullish continuation. So, but with the markets that they are now, as you can see, it's been pretty challenging, and we've had a lot of opportunities on the downside. You can use this on also in a bearish momentum, and for that reason, I put down this. This is not a bullish continuation; it's actually a continuation, as you will see. But majority of the subject with the cup with a handle is on the bullish environment. So I want to clear that. That's how I started, 1988. Not a lot of services, followed this, but it is very visual. As you can see, this is all it is. You have a cup, which is really a saucer. It's a consolidation after again, a big move. This is a bullish consolidation. So you've had a trend, and I will share more charts with you. Then you have what happens. The market hits its highs and then it consolidates again, and that forms a handle. And then we have a breakout of this handle, and that's what basically, again, we will discuss how to use this to our benefit. And basically, there's going to be about 9 points I'm going to go over with. Hopefully, by really digesting that, it might be a lot easier to actually see the pattern, on all the charts that you look at. As I mentioned, this is basically is a saucer plus it could be, it's a flag. Now, in this case, it's a bold flag. It also could be a pennant. So basically it could go either way. So you can see they just married together, and then we can combine that and come with a cup with a handle. So these are the points to consider. There's 9 of them. So basically you want to have an existing trend. What that means is, again, most of the time this is a bowler, so you have an uptrend, but you could also have a downtrend. Now, the trend has to be a few months old. And the reason we emphasize that is you want to make sure that there is enough movement left. And this is not like a 2-year trend and that it's running out of steam. So what Bill O'Neill thinks that, a lot of growth stocks, they have 4 stages. So they move up, they digest, consolidate, they move up again, they consolidate, move up again. So you don't want to be on the 4th stage. You rather be on the 1st or 2nd stage. And that's where this one really works. So again, pay attention that your trend is not too old. And this is on daily, but you could also use on weekly. So we are working on daily right now. The cup is, as I mentioned, it's a rounding bottom. So you want to make sure a U shape, and it's not a V. It's not a sharp, it goes down and sharply comes back up. That usually fails. And I put extra here in this view, if it's like it's a bearish momentum, then it's going to be an N, and it's going to be, it's opposite of a V, for instance. So you don't want to have that. You just want to have an N shape. Now, ideal situation would be for your cup to have equal highs. So it's like a horizontal line. It happens, but there are times that it doesn't. Sometimes the right side is a little higher, or it could be a little lower. So pay attention to that. But the ideal position would be when the cup is very much, if it's possible, is formatted in a way of equal sides. Now, what about the cup's depth? The depth is important because what happens, we want to make sure that there's not a lot of volatility in this, which we have it now. When the markets are moving, so you have a lot of whipsaws. So you want to make sure if the market moved up, it's at a trend and then it's retraced, it usually don't want the retracement be more than 1/3 of that move. So let's say if it had a movement, you don't want to have a huge retracement, which it kind of defeats the momentum of it. So again, Bill O'Neill thinks 1/3 or less is adequate, and that would be good. And the shallower it is, the better it is actually. So basically in that situation, we will talk about the depth of the actual cup again. Now, in volatile market, as I mentioned, it is acceptable if it's 1/2 or 2/3. And guess what those numbers are? 1/2 is not a Fibonacci number, but 2/3 is very close to Fibonacci number. So a lot of times then that half, 50% or 68%, it is accepted. But we rather have less than 1/3 if it's possible in ideal world. Now, we've had that consolidation. Now we have the handle. So so what happens is first we hit the highs and then we consolidate, come down. The sellers are in a mode, taking profits. And then we have this cup forming. And then we go to the next high, maybe a little higher, or the previous high, there's a resistance. Then again, the profit taking happens. Now we have this, again, the bull flag, and it's a consolidation, and that becomes our handle. Now, what happens, as I mentioned, it is like a flag or a pennant. And there are times that sometimes it doesn't even form that. It's just a narrow or small pullback. And sometimes the handle is not even a flag. You will see some horizontal movement for a little bit. And that could also be like a cup with the straight handle. So that also is a possibility. What we are looking for is consolidation, and we will discuss the volume side of it. So Now, the handle itself, so we have the depth of the cup. So we want the handle to retrace to the 1/3 of the depth of this cup. No more than 1/2 it's possible, but the 1/3 is again ideal situation. The smaller the retracement, the better it is. So if we have this cup and we have this retracement, the shorter, and sometimes we have the horizontal, that means that the selling pressure is not that much there. So that means that, eventually we will have a breakout. Now, in order to make sure this is a valid uptrend and it's a valid move, we want to, and again, Bill O'Neill talks about it above the 200 moving average. As I mentioned, I put down below. So if you're in a downtrend, then you want to make sure your handle is below the 200-day moving average. The fifth point is the duration. The cup can extend. So now we have this cup, and what we want to, it would be 1 to 6 months is ideal situation. So if you have a cup, it could be 7 weeks is acceptable, 1 month, but 7 weeks, 8 weeks, more than 6 months, if you're doing on a daily basis, you look at the daily chart, it's very much, too long. So the consolidation is going too long. Again, 2 or 3 months would be ideal. And then if you're doing weekly charts, then you can be longer. Let's say you didn't see in a daily, but you saw there was an uptrend, and then you noticed there's a formation of a cup, it's on a weekly basis, then that could last up to 65 weeks. Now, for the handle, we want to have, again, not too long. Again, we have the cup, you want to have at least 1 week, though. You want to have a short, and then we will have the breakout. So you will have the handle, and it can last up to 4 weeks. So if you have your cup 6 months, it's acceptable to have a handle for about a month. Now, the volume also plays a big role. Now, what happens historically, what we want to do, we want to buy so we are waiting for the cup with the handle to form. And the whole idea is buying on a breakout of that handle on the right side when we have, or the bull flags, which you're familiar with. But the volume plays a key point. You want to make sure the volume on the breakout is at least 50% of the average volume. So you want to make sure that the sellers are coming. The sellers are really drying. And we're having now all of a sudden the buyers are coming with force, and that's what's important. Now, as you will see, we'll have in the chart, you see that we want to see the volume dying down as the price is going down. It's dying down in the bottom of the cup. So it is important that we pay attention to that. That tells us this is valid, that the sellers are running out of steam. As far as the target, so let's say we have that breakout. Now we are ready to go in. As soon as you have the breakout, you come in, and you can combine it with the, like the say candlesticks confirmation that we have spoken. Now, one of the problems with breakouts, as you know, it could be a false breakout. It could be a lot of times there's like people have put let's say if they were shorting, they usually put their stop losses, or if they were looking to go long, they have their targets, and then once there's a false breakout, they get stopped out. So one of the things that's why the trend is important. Usually the breakouts, I would say majority of percentage of the time, it goes to the direction of the trend. So that's what we want to make sure. If there's a breakout, we want to make sure it's in that's what the trend is important. So if you have bullish trend and we have a breakout up, there's a good chance this will not be a false breakout, especially with the heavy volume, especially with the, again, lower volume prior on the consolidation. So what is our target? Usually for the target is, if you're a swing trader, let's say you're doing a 1 month option play or 2 weeks option play. So you're looking for a short term, your first target, or the main target, will be the height of your handle. So we take the from the high to low, and that's the high of your handle. That will be your target. If you're going to be investing and you're going to be a little longer term, then we use the height of the cup. Now, talking about the height of the cup itself, from the high to low, we want to make sure it's about, the average is about 12 to 15%. Now, it could be up to 1/3, again, 33%. So from the high to low, you want to make sure its average is 12, and that makes a valid cup. Now, the cups, the shallower they are, so if it's like 5 or 10%, the better it is. So the more depth of the cup, what happens is that means that there's a little more volatility, and it takes a little longer time for the breakout and time-wise. So again, the rule is shallower. So the 12 to 15% would be a good target to have for the height of your cup. So as I mentioned, if you have a breakout, let's say, of that your handle, then you could look at whatever that 12, 15% represented price-wise, then you can add it to your breakout. Your stop loss. So the stop loss, you can use any type of your technical tools that you use. Generally, it's easier to just look at visually and go like 1 tick or 2 ticks below the low of your handle. Now, Bill O'Neill, and I think someday we should do like on his CanSlim, the 7 keys that he chooses his stocks. We could do that, but he's very much a person of discipline, and he believes that as soon as your stock goes down 8% from your entry, you're out of it, because he thinks that 8% is good enough to give you another day to come and battle. So it is 8% based on Bill O'Neill. Number 9, I put down the volatility. Again, we want to avoid very volatile stocks, and although again with the growth stocks it could always have that, usually they're high beta, but anytime if it's more than 250% move of what the market is doing, and let's say if it's using S&P as a target, let's say that the beta is like 2.5, then that's something that you don't want to be involved with. Okay, so let's look at it visually. So here it is. We talked about cup and a handle, so I want to put everything together and take a look at. We have a bullish trend, and then we hit the highs here, and then we retrace. So now we're building a rounded, looking like a cup, and then we go and we stop right around the highs of the left side. So then we have a little sell-off consolidation, and that's, which is again, you can see it's like a bull flag. It could be again pennant as well. And you see we build our handle. And this is the reason it looks like it's a cup with a handle. And what happens is a downward sloping in an uptrend move. We break out, and that's when we start buying. Now, this is, we want to have a high volume, which we'll talk about. Now, this is the breakout. Some people, if you're really conservative, you can wait till have the breakout out of this high of, or the edges of the cup too. So this is going to be a little early. This is going to be, you can wait for the confirmation and start from here. So you have 2 choices. The other thing is, again, as I mentioned, they are never clean. So visually, that's why I want to share this with you so you can get used to it and understand how this works. Again, the cup, the shallower, it almost becomes like, could be a saucer too, but the shallower, the better it is for your confirmation. Now, as far as the time frames, what we want to do, I mentioned that you want to have, we want to have a nice, 1 to 6 months of a strong trend, and that gives you the odds of the big breakout. When it's like really short term, and it's that I mentioned about also about it's like this is a mature trend. It's been going on for a long time. What happens usually, the movement, we have really run out of steam, so you're not going to have a big breakout. And it goes back again our first 2 criteria that I mentioned. As far as the price action, so here how it works. So this is anatomy of the cup with a handle. You have uptrend stock. Again, I'm working on the bullish side. And then it comes in, it tests the previous highs. And then buyers now, because they are here, they see the highs, they want to take profits. And now the selling pressure, what happens? It makes a downtrend. And now we're having a selling pressure. And it starts basing right on the bottom. And what happens is now we have a little bullish activity, consolidation to the upside. Now the buying is coming back. Now we go back to the high of the previous high. Now we have a little profit taking again. So we have a pullback or the bull or again pennant. And then we have our next move. And all of a sudden, once we break the back of these sellers at here, and then the buying pressure just continues. The other way we can look at it is I talked about now actually the patterns as far as the retracement goes. So what I was talking about, let's say we have, this is the previous trend. Now this, we want this to be about 1/3 or shallower than this big move. So we want to have 1/3. As I mentioned, it could go up to 2/3 or 1/2, and that's in the volatile markets, and also because of, again, Fibonacci numbers, if you shall. But the preferred is about 1/3. So if this move was, let's say, $30, it would be good to have something about $10 or less from this high to this low. And the other ideal situation we mentioned about is it should be 1 to 6 months from one edge to the left to right edge. As far as, again, we talked about the retracement of the, the handle itself. Again, we want to see the height of this cup, and then the shallower, the better. So if it's 1/3 is ideal, but there are times that it could be retracing 1/2. So as I mentioned, it could be also very shallow. It could be 1/5. But these are again, the tools that you could use, just basically looking at the numbers. The other thing is, again, more of a visual on the volume side. Look what happens to the volume. And this is a classic that, as the selling is happening now, the volume is drying. And that's what we want. The sellers are not in control. So now we're getting stronger volume. And generally what we want a volume drying out, going low, and then have a big breakout volume at a higher. So if the average volume is here, we wanted a big push, so higher volume for the breakout. We could also have, I mentioned that actually shallow ones are good. And here you can see how shallow the handle is. And basically we had a shallow cup, and then basically we did have here we had this breakout, and then came down, and then basically we moved out of this handle, and then we started moving up. So that's for the shallow. Now the classic cup and a handle, and again, this is a sample that it could be a little higher. You see the edges from right to left, and then we have a breakout again. So the target, what we talked about, this was the target, the height of this. So, and basically what we want to do once we break out, we want to have that height. I want to consolidate. So these are some of the ideas. Now I mentioned about this is a horizontal handle. You can see we could have the support line here. And now this is a little horizontal, so we don't have the bold flag. The other thing is also, we will talk about inverted, and basically just that you can see that they're not always that clean. So there could be different types, but that was the ideal, is when they are basically resistance line is equal. As I mentioned, because we are in a inverted, in a bearish trend right now. So I thought we can completely turn everything around and think about what if things are going down. So there's something called inverted cup with handle. So this works exactly the same as bullish, except opposite or inverse. So you can see downtrend, trend, and then we have this cup, we have a bear flag, and then we break down. The same thing here. You can use it in Forex, for instance. This is the dollar, and then currencies. You can see again very shallow, and then we break down. The other thing you could use again, when Bill O'Neill did this, he was focusing on a daily, and he's an investor, and he also was sometimes when he uses weekly. But as you can see, you can actually even use on a 15-minute if you like. You just have to be very proactive. So you want to catch the thing. So it could happen on shorter term, but it was built for a daily. But again, I just want to use that example. So what could we use as far as resources? Because there's not really much talked about so as a cup and a handle, but when they work, they're really a good source of opportunity for you. And one of them is if you go to TradingView, they have some resources. They actually, sometimes they come with their suggestions. This is from a week ago, for instance. And they also can, they have resources for us explaining cup and the handle. The other one is actually does have a screen. So it is the chart patterns, and you just look at the cup for the handle. This is as of today. I mean, first, I think it was at 12 o'clock I did this, and it goes all around. So, there's some smaller stocks, and then so one of them I chose was looking for some volume, and it ended up to be an ETF, and it is an inverse ultra short Europe ETF. So it was EPV. So you can use, again, market in and out, and use it as a screen. It does other things, double tops, bottoms. Again, majority of the services do not have, classic cup with a handle, but they do have saucer. You could do, there's a bold flags, and you can, by finding bold flag, maybe combine it, and you can choose that. So I just chose EPV, and this is the reason, again, I use Investor Business Daily. This is, they look at a lot with the fundamentals, and I want to take a look. It's not the cleanest because it hasn't been really that uptrend, but I just want to see the formation of it. So first of all, we are above all the moving averages. So we are in an uptrend, and it is, our relative strength is at 94. You see the volume. This is not as clear as my next chart that I did it in a different, with stock charts. So come looking at this, we can see that the volume really died down. So this is a pretty big retracement. And again, because this is a ETF and it's a leverage, it's ultra short, but it's just visually, I want to get used to seeing that here is the cup and this is the handle. So we are waiting to see, we're almost there if we break out of this, or you can be patient and wait for this. So this is, again, ultra short Euro ETF. So with that in mind, again, I want to make it short and sweet. I hope it was informative. It's, again, a combination of consolidation with the flag, and based on that, usually, there's something that you can use it in indexes if you were using, or in finding your stocks. They can become very helpful, and it applies in commodities and currencies, so in all types of underlying asset classes. Anyway, with that in mind, we can stop and we can ask any questions. So thank you, Sean.